Welcome to TheoTrade. This is Don Kaufman. It's June 23rd, 2018. You are watching the TheoTrade Weekend Update. Let's get started with looking at what appears to be a bit of a mess on your screen. You know, in this weekend's update, we had so much data to display to you that I didn't even have time to put together the video component that we typically do. However, I think what you're going to see in this weekend's update is, first of all, going to be a little bit awe-inspiring, and secondly, there is some incredibly valid information that we're about to present to you that I am telling you, stay tuned in. This is going to impact everyone involved in the markets. So with that, let me go ahead and close up this left sidebar and explain what appears to be an absolute mess on your screen. And to explain this mess, I'm going to go ahead and click this little beaker, and I think it'll give it a much cleaner explanation. What you happen to be looking at, and I'll kind of highlight them here, on the comparison chart is a comparison of some of the major sectors inside of the S&P. So we have, for example, the XLU, which is the utilities, and the XLF, the financials, and the XLK, that's technology select, and then the energy. All right, XLP, all right, XLV, XLY. If you're not familiar with some of these, this is like consumer discretionary. Now, consumer discretionary versus consumer staples, which is XLP, XLV, a little healthcare in there. Now, I don't necessarily have every single sector in here. It was getting a little bit messy. I'm just missing, like, you know, the real estate sector. I didn't necessarily put in the material sector, okay, just for the ease. And the other thing is, all I really wanted represented was sectors that are truly capable, okay, of having a major bottom line impact to the S&P 500, a bottom line impact into the Nasdaq and or the Dow. Let's go ahead and cancel out of there so that we can get a better look at this. What we have, okay, is a fractured marketplace. Now, this particular chart happens to be based right now, it's on the spiders, okay, on a year-to-date basis. Now, again, it looks like a little bit of spaghetti kind of going through your screen, but when I say it's a bit of a fractured marketplace, you guys have heard me use these terms a lot if you've tuned into these videos. There's what they call convergence and divergence. And for the most part, since the beginning of the year, we're just in a wild, all over the place divergence. Correlations are completely breaking apart, but this leaves us, and I'm going to explain exactly why, this leaves us in an incredibly precarious situation for the broader marketplace. And this is not me coming out and saying, he's bearish. Okay, I am bearish on the marketplace and have been bearish on the marketplace for quite some time. But I'm going to show you, okay, in the next few minutes here, is about fractured liquidity and the risk, okay, to the marketplace because of this fractured liquidity. And again, I'll put a little bit more explanation kind of behind that momentarily. Let me begin with just giving you a quick heads up. Now we're going to right click on here and I'm going to show you down below the underperformer. The underperformer right now inside of the S&P 500, it's the XLP, which happens to be consumer staples. Now, we could go into for hours, what's involved in the XLP, and I'm actually going to come to some of that. But I wanted to show you, again, the underperformer being the XLP. All right. Second over here is the XLU. But what's interesting about the XLU, and for those of you that don't know that, it's and here's the XLU rallying back up. This happens to be utilities. Now keep a close eye on that because the utilities have been rallying. Now these happen to be none other than the big time dividend players. This is called your safety play. This is where if you're, a fund manager, you may rotate capital into the XLU, into utilities, if you think that there's going to be a broader amount of risk in the marketplace. Now, right above it, you happen to have the financials. And we've been talking about the financials. Now, they're now down. The financials, if you just want to take a quick glance over from the financials, they're down near close to 3% on the year. And it's interesting to see that the financials are headed straight down the exact same time that the dividend payers, okay, which are your utilities, are headed straight up. Now, in this kind of spaghetti mess over here, all right, we won't go too deeply into this, but there's healthcare, all right in line with the spiders, okay? We've also got right in here is the energy sector, but here's the cause for concern. The divergence, and the biggest divergence, happens to be, first of all, XLK. What is XLK? It's the energy select, I apologize, it's the technology select. Let's get that one right. So it's technology select. It's, for the most part, tech firms. In fact, I'm going to show you that to you here in just a minute. And then on the very top of that happens to be XLY. And if you're not familiar with XLY, well, what's strange about this is it's actually consumer. Consumer what? Consumer discretionary. Now, as I said, there's a huge issue kind of in play, and what I would term not only this large divergence, and it's a large divergence between what's performing and simply what's not, okay? In fact, that divergence is in excess right now of about 20%, okay? And this is, again, huge divergences. You can look back, over many years, and you can kind of snap out to like a 3-year if you want on here, on a 3-year, and see how substantial these divergences happen to be. Specifically, take a look once again at the XLK and the overperformance. So what am I telling you here? You're like, okay, well, I get it. I've seen this, I've seen this movie before. You've basically got what? Okay, you've got one product that's just way outperforming, okay, or one sector that's way outperforming the rest of the sectors in here. Okay, so what's the cause for concern? Well, now we're going to start to discuss a little bit about liquidity concerns. So right now, I want you to extract, if you will, all directional bias that you may have in the marketplace. Just extract all directional bias, okay, and let's just throw a chart up, okay, of the Dow. So we've taken out all directional bias. We're just throwing a chart into the Dow. And of course, the Dow was in a little bit of a downtrend right after it was in an uptrend, mind you. And the reason I want to extract a little bit of directional bias is I want you to look directly into the Dow. And I said that, in this video, we're going to be presenting a tremendous amount of data to you. And from this data, I want you to be able to kind of draw your own conclusions. So this is the diamonds of the Dow. And the reason I wanted to bring it up is I wanted to show you, okay, the issue in hand. And I've talked about, and the reason I'm bringing up the diamonds first is I've talked about the Dow extensively. The Dow is not market capitalization weighted, okay? The Dow happens to be kind of price weighted in Boeing, all right? Being, the 300 and some odd dollar behemoth that it is, Boeing carries approximately and just shy of about 10% of the weighting of the entire Dow, especially inside of the Diamond ETF. This is, again, what is constructing the Diamond ETF. Well, 10% of it happens to be one underlying. If you start to add up, okay, the top, 4 or 5 holdings in here, what are you at? There's about 17%, some quick napkin math over here. Oh, we're pretty much up to 35%. We haven't even gotten to Home Depot yet. And you start to look at the top couple of stocks and you realize, oh, that's, almost 40% of the Dow in terms of its weighting is weighted into a handful of products. Now, granted, the Dow only has 30 stocks, but I wanted to show you how the impact of Boeing alone, okay, is nothing less than phenomenal. In fact, when you start to look at the Dow, when you start to look at Boeing, all right, it's, again, what do you have that's actually driving the Dow? Specifically, you have Boeing because its weighting is so substantial, okay? And I'm using this Boeing example in the Dow, okay, to what I'm about to bring you into, which is the S&P 500 and more specifically the Nasdaq. So I think we all have kind of a keen understanding that Boeing, if it makes a large move, okay, it then reverberates right back into specifically the Dow. That's the only point I want to make. It's not a directional bias. It's just simply that Boeing, for the most part, is going to run the Dow. And the reason is that the way that the Dow works is for every dollar a product moves inside of the Dow, and I'm going to try to script this out, but here's Boeing. If Boeing, okay, is up $1 or, for instance, down $1, that's the equivalency, okay, of plus or minus 7 Dow points. So I'll give you a quick example. If Boeing, again, drops by, let's say, $10, okay, so Boeing itself physically drops by $10, that's the equivalency of about 70 Dow points. Obviously, that's going to have a drastic impact. Why such a drastic impact? Well, if you just look at Boeing in the last couple of weeks, it's, I don't know, it's just dropped from 370, we'll call it 370, down to, we'll call it 340. So it's had a 30-point drop. Just take 30 times 7. What do you get? Well, Boeing itself is responsible for about, just over 200 Dow points getting clipped off. Now, what are some of the other big constituents, if you will? Okay, some of the other big ones that are more volatile products. You definitely have to throw Goldman Sachs into that realm. I mean, Goldman Sachs, this thing's not exactly helping the Dow by any stretch of the imagination, right? You can pull up a chart to your heart's content in here. Doesn't look very good. Just in the last couple of weeks, though, you can see that let's go from, like, say, 260 down to about, we'll call it like, 220, 225. You're looking at some major pressure into the Dow coming from a place like Goldman Sachs. But again, we're not necessarily telling you anything that you don't necessarily know. Now, we're going to take this concept that we're learning from the Dow and we're going to apply it a little bit more to the spiders. This is the S&P 500. Now, the spiders and most of your other major products like the spiders and the Qs, they don't work the same way as the Dow. The Dow, okay, the Dow is like, okay, Boeing moves $1 and your product is going to what? This Dow product is going to make or lose 7 points. That's not the way the S&P or spiders work. The spiders and S&P are market capitalization weighted. That means if you're the biggest boy on the street, you matter the most, okay? Hence why Apple right here, of course, is pretty much, top of the kingdom. So in the spiders, you have about a 4% weighting specifically into Apple. And what you're learning about the spiders, okay, the basket is much more even than it is in something like, well, let's take a look, the Nasdaq. Now, the reason I wanted you to compare and contrast, even in the S&P 500, take a look at, what? 1, 2, 3, 4, okay, maybe 4 underlyings, maybe 5 at most. And these carry, again, the largest market capitalization, the largest weighting. That's about 7. We're at about 10. Okay, with Facebook, it's about 12%. Okay, so the biggest underlyings only have about 12% of the weight. And that's like the top 4 or 5 products in here. And Google's down there. But even Google, okay, Google, if you add up both symbols, is much larger. Google should actually be right up here with in neck and neck with Microsoft. But I just wanted to show you again, that's not like incredibly insane. It's not something like we just showed you a moment ago. And the reason I brought this up, like in the diamonds where the product is totally heavily weighted. Now we're going somewhere with this, and I told you this is a lot of data to kind of interpret in a short, 20-minute video. So here's the spiders. Now in the Qs is absolutely downright dangerous. Apple is almost 12%. Amazon's another 10%. Then you start looking at Microsoft. Yeah, it's good for 10%. You realize we're at the top 3 products, people, and that's already 30% of the Qs. Okay, wait, there's more. You want to actually include what? Okay, Facebook and then Google, because Google is actually 1. So Google accounts for about 9%. Yeah, Google's good for about 9% on top of this 30%. Okay, we're already in excess right here. You want to throw Intel in there? We're pretty much 50% of the entire Q is weighted into the first and a handful of stocks. It's absolutely disturbing that the QQQs are so disproportionately weighted. There's more. Let's take a look at the XLK, because the XLK is your technology sector, right? Technology select. And with the XLK, you got 15% into Apple. You've got 12% into Microsoft. People, it's the exact same underlyings. You're like, so what's wrong with that? Okay. Is there enough liquidity to go around? Wait, wait, I think we should go actually a little bit deeper into this, because what you're about to see, again, is a little bit shocking. Now we're going to go into XLY. This is consumer discretionary. You know what the irony of consumer discretionary happens to be? That it's all weighted into Amazon. It's 22% is weighted into Amazon. Now, deviate back over here. What's back over here? We're going to cruise back to the spiders. We're going to bring up the initial chart that I started with, and that was a sector comparison chart. Okay, and this is on a year-to-date basis. What I want you to see, okay, and what I want you to start to realize on this front, when you start to look to the top of the screen and you right click and you're like, okay, that's XLK, and then this is XLY. Yeah, pretty much the only sectors that are still performing this year, okay, which is disproportional, those sectors, okay, are owned. They are downright owned, okay, by Amazon, by Google, by Facebook, by Apple. Absolutely outright owned. And the issue that really kind of stems from this is when you start looking at the ETF products themselves, you got to first of all know what's in your ETF product. These ETF products, okay, they'll never be able to sustain liquidity in sell-side activity with such a large divergence in the marketplace. That's what this kind of summarizes into, and you're like, I don't necessarily get it. So let me actually again give it to you very, very straight. Let's assume that the marketplace starts to sell off a little bit one day, okay? And sellers start to come into something like an Amazon. So Amazon, which is the outperformer, as Amazon starts to receive some sell-side activity, the sell-side activity in Amazon, now you can see Amazon, this is Amazon versus our comparison, the Amazon sell-side activity has to reverberate into the products where it carries the most weight. Okay, so where does Amazon carry the most weight? Well, you can put up the Qs in there, but you could also put up, all right, the XLY. Okay, and by the way, we can go on and on and on and on. Amazon has huge impact, so the Qs and the XLY. So as Amazon starts to get some sell-side activity, the XLY, which is it's 22% of this thing, will start to spiral down, which will actually force more sell-side activity into the Nasdaq and spiral it down, which will actually reverberate right back into Amazon, all right? I can go on all day about this. Let's talk about something like Facebook. Okay, Facebook. And yes, I just put Facebook into this mess and it's right on top over here. Okay, Facebook is the exact same thing. The weightings have gotten too large into the individual components such that we're not going to be able to sustain. All right, and when I say not going to be able to sustain, here, let me bring you into something like Facebook. Okay, or even better yet, let's go into Amazon. Amazon, on a day-to-day basis, does about 4 million shares. Okay, that does about 4 million shares. Go take a look at something like the XLY, which people don't even necessarily know what the XLY happens to be. It's down negligibly. It trades a little bit of options. I mean, listen, it's a fairly liquid product. Does about 5 million shares over here. Okay, when there is going to be sell-side activity in the XLY, okay, the primary stock that they're going to have to sell is specific to Amazon. Can Amazon, okay, the individual stock, can it absorb that liquidity? And the more that you actually see some sell-side activity in XLY or in Amazon, the more you're going to have to sell the products. This is all arbitrage 101. If you sell Amazon, you have to sell XLY. If you sell XLY, you have to turn around and sell some of the spiders. Why? Because it's one of the key components of the spiders. Okay, but Amazon also happens to belong to the Qs, right? Let's go look. Go look back. Remember the Qs. Amazon is pretty much what? Number 2 inside of the Qs. So it's going to reverberate back into the Qs. The more you start to see and the more fractured, the larger the divergence happens to be, okay, the more fractured the liquidity is going to be. Now, to explain this again in a bit more detail, because no matter how many times I've actually done this and shown it, okay, the first couple of times you see this, you're like, I don't necessarily get it, because there's this wild divergence between these products. It leaves a gaping hole of liquidity in here. And what we're likely to see, and what you probably want to look for in trade in days and days to come, is opportunities to take, okay, what we call long shot positions in, okay, you can go right after XLK. XLK isn't the greatest liquidity. You can go right after XLY and look for what I call long shots to the downside. And those things could pay off massively. Why? Again, when the sell side activity does kick in, it is going to be absolutely vicious to what it is going to do to not only the individual stocks, but what it's going to do to the stock as it reverberates back through the ETF and the corresponding sector. Okay? This stuff is ugly. The divergences have never been this large, this fast. And we've never had weightings like this. So people, I'm not talking about the monsters of tech and, oh, it's 5 stocks that are running the gamut. We're down right now to a handful of underlyings, okay, that are propping up the entire marketplace. And we're going to see cracks. And the biggest thing you're going to see is fractured liquidity. When the market starts to sell off, the one thing to really gain out of this, when the market starts to sell off, you better know your risk. You better be comfortable with your risk because things are going to happen very, very quickly. With that, the SPX holds on to the expected move this previous week. The expected move is right around $31. This next week, we're expecting, and you got to check this out because a little bit of sell-side activity occurs this week. And when I say a little bit of sell-side activity occurs this week, right? The S&P's down mildly. If you take a look at the Nasdaq fairly, sustains itself. Speaking of the Nasdaq, we happen to call for a bearish position in the Nasdaq. That position, we called for a bearish position on Monday of this week. That position is now in the money. We also called for a bearish position inside of Tesla earlier in the week. Hey, check this out. These options are so deep in the money, you have to open up more strikes. So our Tesla position is working. Our QQQ position is working. We have a short position in Boeing. It's working. Caterpillar position. It's working. The Morgan Stanley position, we're right there with that. Now, this next week, as I was saying, this next week is showing expanded signs, all right, of turmoil. That is, there's expanded volatility. To a degree, we're up to about a 12% volatility in here on a $36 move. So week over week, last week we saw a $31 move. This week we're seeing a $36 move. Again, I would be very, very cautious. I will be on an intraday basis a net buyer of options this week. It does look like not only is volatility starting to return to the marketplace, okay, but again, this kind of fractured liquidity picture, which I will discuss extensively more in TheoTrade throughout the course of the week, this is what you really want to keep your eye on. The divergences, again, have never been this large, and we've never had individual products this heavily weighted. It's going to be the world pretty much according to Amazon here. With that, I want to thank you very much for tuning in to TheoTrade's Weekend Update. Have a wonderful weekend. Bye-bye.